You are 41 years old. Your net worth is tied up entirely in physical asset friction. You operate a regional medical courier service with a fleet of 3 used cargo vans. It is 4:45 a.m. on a freezing Monday. You are standing on a concrete loading dock behind a regional hospital center. The air smells like diesel exhaust and wet asphalt. You are personally lifting a pallet of temperature-controlled specimen crates because your driver, Silas, just quit via text message. Your personal credit card is tapped to buy fuel inventory, and your bank account holds $4,200 in liquid capital. You don't check a digital banking app to feel successful. You check the real-time fuel market tracking index to see if your margins will survive the week. The traditional financial system treats you like a micro-risk. You have no institutional leverage. Your cash flow is completely reactive. You look at your face in the reflection of a van window while wiping grease off your hands. The lines on your forehead match the maintenance schedules of your vehicles. At this stage, you are trading your literal spinal health for top-line revenue. You run the routes, you handle the dispatch, and you chase down late invoices from hospital networks. Your friends are moving into middle management corporate positions with clear health packages and predictable vacation schedules. They talk about their retirement matching systems. You eat a cold protein bar while driving down an interstate highway at dawn. You realize you don't own a business. You own a high-stress job that requires constant personal manual labor just to keep the wheels spinning. You are 43 years old. Your revenue has scaled, but your liquidity is a phantom. Your fleet has expanded to 9 vehicles, and your contracts are worth $450,000 annually. But you're caught in the classic mid-market receivables trap. It is a humid Thursday evening. You are sitting in a diner across from an independent freight broker named Clayton. He wants you to take over a multi-city medical delivery network. The contract is massive, but the payout structure is net 90. You need $35,000 up front just to cover fuel and payroll before the first invoice clears. You drive a basic commercial pickup truck with 140,000 miles on the engine. You look at the luxury sedans in the parking lot, realizing those owners have no concept of cash velocity. You aren't drowning, but your capital is frozen in the balance sheets of your corporate clients. Commercial banks refuse to give you an unsecured line of credit because your business assets are categorized as high depreciation transport equipment. You're forced to look at alternative capital allocation. Your lifestyle is tightly restricted. You don't take family vacations because an engine failure on Route 4 could wipe out your monthly profit margin. On your midnight walks through the industrial park, your mind calculates invoice aging charts. You realize that building wealth at this level is a game of survival arithmetic. You are working 70 hours a week just to act as an unpaid credit facility for multi-million-dollar healthcare conglomerates who hold your cash to optimize their own treasury positions. You are 45 years old. Your operational volume has broken through the middle market ceiling, but you have stopped begging retail banks for expansion capital. Your asset base has reached $180,000. It is 7:15 p.m. on a stormy Tuesday. You are sitting in the back office of a private asset-based lender, signing a structural factoring agreement. You aren't borrowing money against your personal name. You are leveraging your net 90 institutional invoices as collateral to extract immediate liquidity at a discount. The standard banking system still views your business as a volatile logistics operation, but the private credit market understands the value of your corporate contracts. The private lender advances you 85% of your invoice values within 24 hours. The 4% factoring fee is expensive, but it gives you immediate strategic velocity. You use the cash injection to buy 4 refrigerated trucks directly from a liquidating competitor. You don't post a victory announcement on LinkedIn or tell your industry peers. Private capital moves best in the dark. Your lifestyle is completely separated from your balance sheet. You still wear basic industrial work shirts and drive the same high-mileage pickup truck. Your competitors think you are struggling because you don't lease a shiny fleet of new vehicles. They don't see the structural reality. Your private financing engine allows you to capture market share while they wait weeks for bank loan approvals. The shift: you stop looking for traditional validation. You begin using private debt as a structural weapon. You are 47 years old. Your logistics framework produces $1.2 million in annual gross receipts. You have achieved structural stability, but you have completely decentralized your risk. You have established a dual-entity holding structure in a protective legal jurisdiction. Entity A owns the trucks and equipment. Entity B holds the lucrative hospital contracts and leases the vehicles from Entity A. It is 6:30 a.m. on a misty morning. You are standing in a newly leased fulfillment warehouse, watching automated sorting belts run. You have entered the elite tier where personal identity is completely removed from asset ownership. To your neighbors, you are a quiet neighbor who leaves early in work boots. You have zero public digital footprint, but your holding company owns the warehouse land outright. Your cash flow is protected by a corporate shield that insulates your capital from operational liabilities. If a truck gets into an accident tomorrow, the litigation stops at the operating entity. The core treasury remains completely unassailable. You meet with your corporate structuring attorney, Elena. You are closing a deal to purchase an independent cold storage facility. You aren't using your personal savings or standard real estate mortgages. Your holding company utilizes an asset-backed credit facility secured by your warehouse land and equipment equity. You watch the warehouse crew load freight crates. You realize the deep truth of your 40s. Wealth is not built by collecting a high salary. It is built by engineering corporate structures that preserve capital and control risk while keeping your name completely invisible. You are 50 years old. Your holding company network controls logistics infrastructure valued at $3.4 million. You are no longer managing routes or loading pallets. It is 3:30 p.m. on a clear Thursday afternoon. You are sitting in a private conference room downtown, reviewing a syndication prospectus for a regional distribution terminal. You are entering the deal as a general partner, bringing your operational footprint and logistics equipment as your equity contribution. At this tier, your personal financial history is completely irrelevant. Institutional syndicators do not pull consumer credit profiles. They look at your asset utilization metrics and structural cash flow history. You use your corporate proxy to control a multi-million-dollar terminal without deploying a single dollar of your personal cash. You discuss facility throughput tariffs and preferred distribution tiers with institutional syndicators who treat your enterprise as a premier infrastructure partner. You are playing a pure game of structural arbitrage. Your personal life remains completely unpretentious. You drive a clean, basic utility vehicle and live in the same house you bought a decade ago. You do not display your net worth or buy consumer luxury symbols. Visibility is a target, and silence is your defensive fortress. You spent your early 40s lifting crates on freezing concrete docks, only to discover that the manual friction was the exact data set you needed to learn how to build, control, and protect permanent institutional infrastructure. You are 53 years old. Your private holding network has matured into a sovereign asset ecosystem worth $6.2 million. It is sunset on a quiet autumn evening. You are sitting on a wooden bench looking over an expansive piece of raw commercial land you recently acquired through an off-market bankruptcy auction. The area is completely quiet. Your life is funded entirely by a low-interest corporate credit facility secured against your logistics real estate portfolio, giving you massive liquidity without ever triggering a personal income tax event. At this level, you are completely disconnected from the public financial matrix. You don't use retail banks, you don't worry about standard interest rates, and you don't participate in consumer display culture. Your family office trustees manage your assets behind a wall of private family trusts and blind proxies. Ensure your name never appears on any public county clerk registry. You are fully insulated from the economic volatility that breaks the standard investor. Out of pure habit, you pull up an old digital archive file on your encrypted laptop. You scroll past the warehouse deeds and private placement contracts until you find an old photo from 12 years ago. It is a picture of your first cargo van with a cracked windshield, parked outside a hospital loading dock at 4 a.m. You look at that old image and feel absolute clarity. You realize that the exhausted 41-year-old man lifting crates in the freezing dark was the true master architect of your current sovereignty. He abandoned the retail illusions early, allowing you to build a fortress in absolute silence. You are 56 years old. Your infrastructure holding system controls $11.5 million in real-world assets. At this scale, your relationship with cash undergoes its final structural evolution. You no longer build wealth. You direct its velocity through cross-border leverage facilities. It is 4:15 p.m. on a quiet afternoon. You are sitting in a private office in a global trade hub, reviewing a liquidity contract backed by your international freight contracts. You aren't liquidating physical real estate or selling your logistics fleet. You are using your corporate equity to draw tax-free institutional credit lines. The international banking cartels treat your private holding ecosystem as a sovereign financial entity. Institutional wealth data confirms that the ultra-wealthy do not liquidate their holdings to fund their lifestyles. They borrow against their assets to preserve their principal and completely bypass personal capital gains exposure. You find yourself casually coordinating asset-to-liability ratios and variable interest hedges with private capital managers who treat your personal name as a corporate brand. You are playing a game of pure financial abstraction. Yet, the memory of the concrete loading dock remains your permanent anchor. You look at the multi-million-dollar credit agreements and feel no anxiety. You are using debt as an institutional weapon to accelerate wealth velocity, not as a consumer trap to fund a lifestyle. You drive home in an unbadged utility car, realizing the ultimate truth of your journey. The grueling, self-funded years in your early 40s were the exact training ground required to strip away your consumer programming and teach you how to dominate the silent mechanics of capital. You are 60 years old. You have achieved absolute, multi-generational financial sovereignty. Your family's economic life is entirely insulated from the public grid by an elite trust architecture. It is sunset on a crisp winter afternoon. You are sitting on the outdoor terrace of a stone mountain property, watching the last golden light hit the snow-covered peaks. The valley below is completely silent. Your entire global lifestyle is seamlessly sustained by an automated, asset-backed credit facility managed by your family office trustees. At this tier, your wealth is completely invisible to modern civilization. You do not own a single piece of real estate in your own name. You carry no personal bank accounts, and you never interface with retail financial systems. Your legal team directs your holdings through a matrix of dynasty trusts and holding companies, ensuring that your wealth passes to your heirs completely outside of public probate courts or tax disclosure registries. You are completely insulated from every material and structural worry of the modern world. But as the mountain wind cools, you open your secure digital vault out of pure habit. You scroll past the international distribution hub deeds and private equity structures until you find a digital text file from 19 years ago. It is the old maintenance ledger for your first 3 cargo vans, written when your total liquid capital was $4,200. You read those faded log entries and feel deep gratitude for the physical struggle of your youth. You realize with absolute certainty that the exhausted 41-year-old man standing on that freezing loading dock was a true savior of your family line. He abandoned the retail lives of his generation so you could build a permanent fortress in the quiet. The horizon darkens. The vault remains silent.